Good morning, everyone. This is Jamie from Stonehearth Capital Management. I hope you're doing well today. Today I got just after 10 o'clock, so we're going to get started right now. Today we're going to address, can you afford to retire? We're going to go through a couple of areas that you need to make sure that you explore. So thank you again, everyone, for joining. Just a reminder, this is recorded. We also have a white paper that I've written, and that is going to be uploaded to our website along with a list of all the future events that we'll be holding. So stay tuned. Oh, my mouse doesn't want to. Let me see if I can enlarge this. Good. So you should be able to see my screen right now. I presume somebody would run in here if you couldn't. So what I want to do is the areas that I want to address today when we're talking about retirement. I want to talk about pensions, Social Security, health insurance, required minimum distributions, and a couple of additional observations that I want to make. First, when we talk about retirement, it's commonly said that it's not a dress rehearsal. I think that's true. We want to make sure that you don't need to do this over again by going back to work if you got it wrong in the first time. Obviously, life will throw curveballs at you, so you need to adjust, and there's no guarantees in life. But at the same token, with the data that we have, planning ahead, there are certain things and rules that you need to pay attention to. The general rule out there when you're talking about can somebody afford to retire, the thing that you're looking for is whether their portfolio will outlast them. Or as some of my clients like to say, some of them are okay if their last check bounces. So, the primary objective is to make sure that your portfolio outlasts you. So while the concept is simple, the analysis to determine whether your portfolio will outlast you is where things can get rather complex. For the most part, what you have is your sources of income, whether it's pension, Social Security, and then what you look for is to fill the void. So if your expenses are $100,000 a year and pension and Social Security are taking care of $60,000 a year, then you need $40,000 a year coming from your portfolio. And is your portfolio large enough to support that kind of withdrawal? So I'm going to show you some of the things in particular when it comes to pension, Social Security, where making an election might have a big impact. Is that number going to be $60,000 a year of guaranteed sources of income, or is it going to be $55,000, $65,000, or maybe even $70,000? So let's dive right in and start taking a look at pensions. So the sad news is that pensions are becoming obsolete. Most employers are favoring 401k and 403b plans as a cost savings measure. So that's obviously a hurdle for many, because now the onus is being put on the employee within the 401k and 403b. And while the employer is matching, most employers, especially the ones that did away with their pension plans, while they're matching their employees' contributions, usually that's not enough, or at least it's not what they were being forced to put into the pension plan. So the employers are happy with that. Plus, it puts the onus on the employee to take care of themselves for the rest of their lives, not for a pension or an employer to have a team to manage their pension plans, which puts the responsibility on the employer. So the first thing that you need to look for if you're fortunate enough to be entitled to a pension plan, is whether there's a monthly income stream or a lump sum option. Both, they're both valid. Sometimes people don't care either way. They just want to let the financial plan dictate which one they should do. Sometimes people look at other factors like whether or not they have kids. It seems to be a big one. If you have kids, there tends to be a preference for lump sum, because that increases the chance that your children would inherit something. If you do the monthly income stream, most monthly income streams are only good for that participant or the employee that just retired, and or their spouse, depending upon whether you elect a survivor benefit or not. If you elected to do the lump sum option, you typically can roll that over into an IRA account. And what's nice about that is you can preserve the tax deferred status, which is important. So you're not going to owe taxes when you take that lump sum check. You can take the check and not roll it over, but then it would be fully taxable to you, and the tax hit, depending upon the amount of that lump sum, could be large and could push you into a rather large tax bracket. The third option is to turn on the monthly income stream. It's not the third option, it's just the third bullet point that I have here. So it's again lump sum and monthly income stream. The monthly income stream, down below I have a typical illustration from that an employer would provide with your options. So if you look at option 1, and again this is if you opt to collect a monthly income stream, your employer may provide $5,000 a month to you for the rest of your life. If you pass away and you elect a 0% survivor election, what that means is when you pass away, your spouse receives nothing. So as a result of only having to take care of one person's lifetime, they're willing to pay you more than they would if they needed to provide benefits to another person, albeit your spouse. So option number 2 is, look what they'd offer you, $4,700 a month. So there's a $300 a month reduction. And that's if you opted for the 50% survivor, which means that your spouse would receive $2,350, which is half of the $4,700. The third option is to receive $4,425 in exchange for 100% survivor election, which means your spouse would continue that benefit. Now, I've seen some plans that have 3 pages worth of different options available. Sometimes they supplement it with Social Security. Sometimes these are broken out differently. Teachers here in Mass don't have the 50% option. I think theirs is 66 or 67%. It's a 2/3 payout. We have a lot of GE employees, and they have, it's rather new. I mean, it came out maybe 6 or 7 years ago, and they have now a 75% option that's available to them. So you want to take a look at that information, analyzing the first step. If you do have the lump sum as an available option along with the monthly income stream, the first thing you need to do is sort of identify, well, which one financially is more appealing to me. Now there's ways that you can just run that stuff in Excel, but the challenge that a lot of people have is it's not showing all of the moving parts. That's why they have financial planning software. So the more sophisticated softwares will be able to properly analyze this, taking into consideration things that are influenced by that decision, such as portfolio values or income taxes and how that all plays out. So just to give you a sense, this is what we use. It's a cash flow model. And I know there's a ton of numbers here, and all I want to do is just give you a sense that we're looking at 2 scenarios. This right here is if you chose the monthly income stream, and this over here is if you chose the lump sum pension. So what we do is we run these 2 scenarios next to each other. I think in this one, by the way, Paul and Lynn Price are not real clients. It's, as you can tell, it's a sample. And I think in this one, Lynn was going to receive $60,000 a year or $5,000 a month, or she could receive a lump sum at $950,000. So in this scenario, we rolled it over into an IRA account, and in this scenario, she collected the monthly income stream. Now, whenever you get a lump sum, obviously, that's ahead of the game right out of the gate because you got your money in advance. So what you look for is a point in time where all of a sudden the portfolio value no longer exceeds the portfolio value of the income stream. And here we call that break even, and here you can see that I highlighted it already. So at age 88 and 88 for Paul and Lynn, that seems to be the break even point, where anything above this, the lump sum option is preferred. Anything below here, the income stream is preferred. Now, this does depend on what assumptions you want to utilize for the lump sum. So you just have to run different scenarios of what you feel comfortable with for expectations of rate of return over a your lifetime. Really, it's a 20, 30 year time frame. I think in this illustration I used 4 or maybe even 5, somewhere in that vicinity, and it worked out to that break even. So that's the kind of analysis that you really need to have done. Again, I caution, as I will with Social Security, there are tools that just look at the break even point of the income versus the lump sum, but they do not take into consideration the impact on portfolio and taxes, which are hugely important, and I'll give you a sense of that when I look at the Social Security one. One other option, and I'll come back here just for a second. If you were going to offer, if you're contemplating the monthly income stream, and you said, well, I would at least like my spouse to receive $2,350 if I were to pass away, but boy, I really would like the $5,000 because we're just not sure. So we're confused as to which option we want to go forward with. Well, I guess to some degree adding a little bit more confusion to it, because there's another option available. As long as you're insurable for life insurance, one of the things that you can do is go out and purchase a life insurance policy for the retiree, for the employee that's collecting this pension, so that if they passed away, the benefits, the death benefit would be paid to the spouse, and in essence would create a block of money that they could generate income from. That's the same exact thing that this group is doing, where if you pass away, well, then the benefit's going to be paid to the survivor. So how much life insurance? Well, you just want to get as much life insurance you can for up to $300 a month. And one of the perks there is, if you no longer need the life insurance because you're 85 years of age and you say, you know what, the plan says that we've got plenty of money. If one of us passed away, the surviving spouse is going to be just fine. Well, then just cancel the policy or let it lapse. And then that person's been collecting $5,000 a month for a long period of time. They've been paying $300 a month, so they really haven't profited anymore versus option 2. But then at any point in time that they want, they could cancel the life insurance policy, and then everything, that extra $300 a month would truly be gravy. Okay, so just something to consider. Again, if you have to be insurable, if you're not insurable and couldn't get good rates, then you need to start looking at these survivor benefits, because there is no underwriting. They don't care how healthy the spouse is or the employee. These are the terms based on your age. The next section I want to go over is Social Security. And just a reminder, my colleague David Giuliano, he's one of the other advisors here at the firm, he did a presentation on Social Security. So he went into all the different claiming strategies. I'm not going to. If you want to take a look at that white paper, he did a really good job of illustrating each one of those. It's right on our website. There's a tab for archives and white papers, and you can see all of the white papers. Each one of these presentations or webinars that we're doing, we're writing a white paper along with this, just so that it's convenient for people, or more convenient if they want to just go ahead and read a couple pages of data. So when we're talking about Social Security, the thing to remember is benefits can start as early as age 62 and as late as age 70. And if you're a widow or a widower, you can actually start as early as age 60. Again, for widows and widowers, there are some strategies that still exist that are valid that you need to consider. If you are a widow or a widower, or if you know somebody that is, they really should talk to a professional to understand what options are available to them. We've had new clients come in that didn't know that they had options available to them, and they could have been collecting income. So I stress, if you know somebody that's a widow or a widower, just make sure that they're getting help. If they're not, give us a call. The other thing is you are entitled to 100% of your Social Security benefits when you reach age 66 to 67, and that does vary for dependent upon your year of birth. It's sort of simple. If you claim early, your benefits are reduced. So again, if I were to turn my benefits on as early as age 62, well, there's usually about a 25% reduction from what I could have received at 66 to 67. And then vice versa, if I were to delay until age 70, I would actually get an increase. It's actually a 132% increase from full retirement to age 70. So, you know, that's a nice perk. Every year that you delay, especially after you reach this full retirement age, there's about a 7 to an 8% increase that they call delayed credits. Once again, there are some tools out there that allow you to analyze the break even for Social Security benefits, but the way to do it properly, taking into consideration if your portfolio and taxes, you really need to run this stuff through a financial planning software or some kind of more sophisticated software so that you can actually see the impact of delaying your Social Security benefits. An obvious example is if you were going to turn on your benefits at 62 and you could get $1,000 a month and you chose not to so that you could get a higher Social Security benefit when you claimed, well, that means you need to supplement your income somehow if you're not working. If you are working, that's fine, but if you're not working, then how are you going to generate that $1,000 a month if that's what you needed? So you would need to take that money from your portfolio, and this is what I mean. The normal calculators, Social Security calculators, don't take into consideration that you've got to draw down on your portfolio or you got to get income from someplace while you're not collecting Social Security. Again, this is not a problem if you're working, and just one caution, if you are working and you're under your full retirement age, there are income limits. I think it's around $16,000. It's subject to inflation, so it changes every year, but it's around $16,000 so that if I'm working and I'm 62 years of age and I'm earning $40,000 a year, I should not turn on my Social Security because Social Security is just going to penalize me. Let's take a look at the software. Again, same concept. These are the columns. We look at the portfolio value, and this is somebody that's turning their benefits on early versus somebody that's delaying as late as possible, which is age 70. And this is a great illustration or a great way to just get a sense of the Social Security calculators won't always pick up on these things. So if you put it plugged in to a Social Security calculator that you're going to live until 90, most of those tools are going to tell you that you should opt to delay Social Security until age 70. Well, here's a scenario where the portfolio value, and I apologize that these are small, at all of these time frames were never as great as turning the benefits on early. So again, it all depends on where your assets are because the portfolio has a big impact on whether you choose to delay benefits or turn them on early. And the best way to analyze this data is to run it through a financial planning software that has your information in it. Let's switch gears and go over to healthcare. If you're going to retire prior to 65, hopefully your employer offers some kind of health insurance benefits for you. Many times, I know General Electric, if you're fortunate to retire from them, you can continue those health insurance benefits until you reach age 65, which is a nice perk. And they also make that available for your spouse until they hit 65. So you need to check and look at not only your own benefits, but maybe you can go on to your spouse's if your own benefits are not accessible to you. The option of last resort is if you can't get health insurance after you retire prior to 65 from your employer or your spouse's, you really need to start looking at private health insurance. And just to give you a sense, it does vary between states. We just recently ran some quotes for clients out in California, and it was higher than it was here in Massachusetts. So we've seen some of the differences, and they can be quite different depending upon where you retire. We use about $1,000 a month per person if they're going to acquire private health insurance. If you are fortunate enough to get health insurance through your employer, usually it's subsidized, and many times you'll actually pay the same rate that you were paying prior to retiring, which is a very nice perk. Once you reach age 65, so here's another key date that people need to watch for. 65 is when you're eligible for Medicare. And in most instances, even if you're working, many times you'll still sign up for Medicare Part A, which is the free version of Medicare. If you don't, there will be penalties. So you always want to coordinate when you turn 65. You need to ask questions. If you're not working and you're eligible for Medicare, you need to apply. Usually, I believe they send you information about 3 months before. You can certainly do research prior to that, but you want to pay attention to that age 65 deadline. If you are working, then I would suggest that you check with your HR or benefits team to just make sure that you coordinate things properly. There are two major paths that you can go down. Your choices include Medicare Advantage and Original Medicare. Medicaid Advantage, I tend to refer to as the one-stop shop. It's somewhat similar to how our health insurance benefits work while we're employed. The original Medicare is the one that has the different parts, and I call that a la carte solution. So it's got Part A, Part B, Part D, and usually Medigap or a supplemental policy. In all of these scenarios in financial planning analysis, we use $400 a month, inflating that amount at 5%. So again, when we're illustrating what it's going to cost you in retirement, once you're on Medicare starting at age 65, we project $400 a month. That's per person, inflated at 5% per year. Obviously, there's a lot going on in Congress, and a lot of this can and probably will change, but that's what we're using today. I just want to reference one of the resources that's available. SHIP, which is the State Health Insurance Program. You'll see it down here. Every state has one. Here in Massachusetts, they changed that name to SHINE. And I can't remember, there is a different one also in New Hampshire, but I can't remember the name of that. Maybe that one is SHIP, but here in Massachusetts they call it SHINE. If you go and do a Google search on SHIP, or if you actually download the white paper, I included a link that you can find your state's plan or your state's team. These are a group of consultants that are experts in Medicare, and they're willing to counsel you on your health insurance options. Whether that's your employer's supplemental policy, because sometimes your employer will provide access to, we call them supplemental, another word for it is Medigap. These are types of policies that you take out with your Medicare Part A, B, and D. And sometimes the supplemental policies or Medigap policies will replace, maybe it has prescription coverage included, so you wouldn't need Part D. You just got to do that kind of research. But many times if you're given access to an employer-sponsored plan, it's either subsidized or it's discounted, so the rates are usually better and the coverage is usually better. So it does, it's something to give consideration to. If you're not fortunate to have some kind of access to your employers, or your employer does not make accessible to you some kind of supplemental policy after you reach 65, then you'll have to go to one of the exchanges or call insurance companies. I know GE has a group called One Exchange that helps their retirees. I've got another group that I haven't actually called them, but I just received some information about a month ago, and they work nationwide. Across the nation, not the insurance company nationwide, where they are able to help you in the same way that this group One Exchange helps GE employees and a lot of other employers. There's also locally, I have an insurance agent that I can put people in touch with. It's also all dependent upon what you're looking for. If you're looking to learn more and have somebody go over the available options for you, then I think starting with SHIP is a great place to start, and it's free. The next age we need to worry about, 70 and a half. At 70 and a half, we're required to take minimum distributions. We call them required minimum distributions, or RMDs. Some groups call them MRDs. The key is, if you have a 401k, a 403b, an IRA account, most often those funds in those accounts are pre-tax, meaning they've never been taxed before. And the IRS would like to receive some tax revenue, hence why they make this required. So what they do is they force you to take money out. Now, you don't have to spend it, they just want you to take it out. And the reason for that is because when you take money out of a retirement plan, like a 401k, like a 403b, or an IRA account, there's also one simple IRAs, SEP IRAs, there's a magnitude of other types of accounts that this applies to. You need to take a distribution. Just please note that Roths are not included in this, even though people call Roths a retirement account, which is true. Roths have money that's already been taxed in it, so that's why you aren't forced to take money out of the plan, because it wouldn't generate additional revenue for the IRS. So just so you have a sense, when you turn 70.5, you need to take out approximately 4.5% of your account value. So if it's a $100,000 account, you need to take out $4,500. Typically, the IRA provider or 401k provider will withhold taxes for you right away, and that's a good idea, because unless you're making quarterly estimated tax payments separately, but it is pretty convenient that as you take the withdrawal to just go ahead and have taxes withheld at the federal and state level if state applies to you. The second year, it will increase to about 4.75. The percentage does increase. The formula that they use is the prior year ending value of your retirement account divided by a factor that is tied to your age. So as you get older, the factor reduces, which results in you taking more money out of your IRA or retirement account. One suggestion, automate the process if you can. If you fail to take the required minimum distribution, the penalty is 50%. Now, there are some ways, and I've helped clients over the years that either they didn't know or forgot, or somebody passed away and they're the beneficiary and didn't know that they need to take these required minimum distributions. There are some things that you can do to sort of ask forgiveness from the IRS. There's no guarantee that they will do that, but there is a process. So if somebody ever forgot to take their required minimum distribution, the key is to fix it as soon as you can, and then follow some procedures. Again, there's no guarantee that they'll waive these penalties. There is one exception when you do not need to take a required minimum distribution, and that happens to be if you are still working and you are less than a 5% owner of the company. If you're greater than a 5% owner of the company, then you still need to take RMDs, or required minimum distributions. But if you're an employee, you don't own the business, and you're working past 70, you do not need to take required minimum distributions from that employer's 401k. If you have old 401ks or money that's been rolled over to an IRA account, then yes, even if you're working past 70.5, even if you don't own greater than 5%, you still need to take required minimum distributions from accounts not associated with that employer. A couple of other observations. This is some of these are higher level. Expenses, they typically drop. So when you're working, we'll call those expenses at 100%. So let's just use expenses maybe of $100,000. If and when you retire, we expect that, we see that most people's expenses go down by about 15 to 35%. Much of this has to do with taxes and 401k or 403b contributions. So if somebody making $100,000 a year it also has $100,000 a year of expenses, and they're contributing $20,000 to their 401k, well, when they retire, they're not going to be contributing to that 401k any longer. So right away, we know that they're going to have their expenses be reduced by 20%. Additionally, since you're not earning an income, typically your taxable income goes down, and hence your tax liability goes down. Don't get too excited though, because when you turn 70.5, those required minimum distributions they need to come out of your retirement accounts, that triggers taxable income, and it usually pushes your taxable income and tax liability higher once again. The good news is that it's usually not as high, your tax liability is usually not as high as it was when you were working. A lot of people relate this to effective tax rates and tax brackets. So again, when you're working, your tax bracket or effective tax rate is probably at its highest. Then it should go down after you retire, and then it will climb a bit once you hit 70.5 and you need to start taking required minimum distributions. By the way, that happens to be a great time to give consideration to contributing to Roths, or what they call IRA to Roth conversions. If your taxable income is going to be lower than normal and it's expected to increase, then those are key years to give consideration to doing IRA to Roth conversions. I'm not going to go into any more detail on that, but it's something that a lot of people should look at. We look at it for all of our clients after they retire. Inflation. Inflation is probably the biggest known headwind for retirees. In our financial plans, we use 3.74% in inflation. Right now, inflation's running, I think, sub 2%, right around there, and the Fed is trying to keep interest rates around 2%, although I thought she just recently referenced maybe going up to 2.5%. But we're in that area. Again, our plans, we think, are more conservative because we use the 3.74. However, that is the average for CPI, Consumer Price Index, over the last somewhere around 80 years. So we just happen to be in a lower than normal inflationary environment. But the average has been 3.74. Just think about the early 80s when inflation was in the teens. So clearly it can become a problem. Just to give a sense and put pen to paper so that people can see just how much of a problem this can be. If your expenses today are $100,000 and we're seeing inflation grow at 3.74, over 19 years, your expenses will now equal $200,000. And the key is you're still living the same life, same standard of living. You haven't changed anything. So 19 years ago, you were living your life spending $100,000. You're doing the same things 19 years later, hopefully, and now that's costing you $200,000. It's a problem because people that have pensions many times don't have inflation coverage or built in. They call them cost of living adjustments. So that your pension, if it's $50,000 a year, it usually stays at $50,000 a year. If you're fortunate to have a cost of living increase, then that should change over time and increase. Social Security does increase with cost of living. It may not be perfect, but it does have some cost of living increase. Your portfolio is the other variable that hopefully does have cost of living, and that's why many people need to take risk, because risk is usually your friend, not always, but usually your friend, and that should allow you to take larger withdrawals over time. I want to go over a couple other variables, areas that you need to give consideration to. Higher than normal inflation, as I mentioned in the early 80s, that can be devastating for retirees, so that what you're spending, if it's $100,000 today, next year all of a sudden it's $113,000 a year, man, that would change your finances rather quickly. So you have to pay attention to that. Higher tax rates, that's also something that needs to be taken into consideration. I know the environment right now looks like we may have lower tax rates, but that's not always the case. Higher health insurance costs, another thing that's commonly referenced right now. Nursing home costs or risks. I did do a presentation a couple of months ago on how to protect your assets from nursing homes. If you're interested in learning more about that, you can go to our website and download the white paper or watch the video. Lawsuits, there's a lot to be said for having an umbrella policy. If you're in a litigious environment, that you need to pursue some kind of insurance or ways to protect your assets to mitigate some of that risk. And then portfolio drawdowns, just think of 2008. It's one of the reasons why we are active risk managers, to pay attention to the downside risk in portfolio, because the drawdowns for retirees can be substantial. There are tools to address each of these potential issues. You can't fully insulate yourself from all of these risks, but you can reduce these risks if you take the time to plan ahead. So coming back to the whole idea, can you afford to retire? If you want to do analysis right, you need to sort of be prepared to roll up your sleeves and get dirty. It's the sites that you see that ask 4 questions and it tells you whether you can afford to retire. You know, they're not robust enough. There's too many. There's too much room for error. You really need to take the time to put together a comprehensive financial plan that would help you analyze your scenario. I think you know, it's time and energy well spent. If you have the time and energy and resources to do it yourself, then you're well on your way. If you don't, then I would suggest that you hire a professional. I like to say that you know, if you've been thinking about retiring, you'll be happy to know that our firm has been thinking about it for 35 years. We've been helping families answer that question for a long time now. So if you need help answering that question, please feel free to give us a call. We're happy to help you put together a financial plan that will help analyze this and more. Just a heads up, the next webinar that we're putting together is the ABCs of trusts. I will be presenting that, then followed by what every beneficiary should know. We actually referenced some beneficiary details when we were talking about required minimum distributions, and that's going to be an area that I'm going to focus on, and it's an often missed area that beneficiaries didn't know that they needed to take distributions. My colleague David is going to do not the final one, but the final one listed here on college planning, and that's in September. If you want to sign up for any of these, just go to our website. It's fairly simple, and it will send you an automatic reminder. So that's the end of my prepared remarks. Amanda, if there are any questions that anybody has or has typed in, I apologize, I didn't reference that at the beginning, but if you do have a question, you should be able to go ahead and enter in the box on your screen what your question is, and I can try to answer it.
Hi Jamie, we do have a couple of questions. The first one I have here is, you mentioned something about purchasing life insurance when you were referring to pensions. How does that work?
Yep. So it can be a little tricky. Again, this comes back to this: if you're choosing a monthly income stream, you typically, to do this right, you want to purchase what's called a permanent life insurance. The challenge with permanent life insurance is that it will be hard to purchase a strong enough or a policy that has a large enough death benefit with $300 a month. So what I typically will look at for clients, because that is just a struggle to try to find. It all depends on what these offers are. If a 50% survivor election meant that you were going to receive $4,400, well, that gave us a little bit more breathing room, so we might be able to do that. It all depends on the terms that your employer sends to you to see what you can do. We do a lot of these for GE, and it tends to be that we can't go get a permanent policy, but quite honestly, the majority of the risk for the surviving spouse is that the retiree passes away right away, right after they sign on the dotted line. So if they elected $5,000 a month and they passed away the next day, well, then the surviving spouse is not going to get anything. Now, some employers offer a 5-year guarantee, so even if that spouse did pass away, they'll at least pay that $5,000 a month for 5 years. But 5 years is not going to cut it for the surviving spouse if they have 20 or 30 years of life expectancy. So what we'll tend to do is understand that the greatest amount of risk is early on after you sign up for these benefits. If both individuals or both spouses are 90 years of age, how valuable is the surviving pension to that surviving spouse? It's probably not as valuable. So because of that, what we've tended to look at is our term policies, and term policies of either 15 or 20 years, and purchase as much life insurance as we can with the term policies. And that has actually worked out very nicely. There's risk there. You know, there is risk that maybe the 90-year-old did need the money, but it seems to be an option that works for many families, and they seem to be happy with the results. So again, it's just trying to replace the survivor election with life insurance so that the retiree can go with option 1. And when they choose or determine that they no longer need the benefits, they can just let that life insurance policy lapse.
The next question I have here is, I heard that some claiming decisions for Social Security are no longer available. Is this true?
Yeah, that's a good one. So again, I'll point people to David's letter because he'll do a better job of going through a lot of those. They did get rid of some benefits. It had to do with file and suspend and filing an application for restricted benefits. The key is we're still doing restricted applications for clients. So there's an age, I can't remember the exact age right now. I think it was you had to be 62 by January 1st of either 2015 or 16. I think it's actually 16. Again, I'd point you to David's letter. It's right. You can download the white paper right on our website. It's got all those details. But yeah, if you're grandfathered in, so right now, you know, people that are, I think, 63, 64, 65, and 66, those individuals, we're still filing restricted applications. Just to give you a quick tutorial on what restricted applications are. So if both spouses are full retirement age and both of them are entitled to $2,000 a month, they could turn that on, or both of them could delay and just wait until a 70 when they'd get a larger benefit. But sometimes what we look at is, well, they need some income, they're retired, so at least one of them wants to turn on benefits while the other one says, well, you know what, I'll delay mine and you turn on yours. That way we know that if and when one of us passes away, the survivor is going to get the higher of the two Social Security benefits. So there is an edge in doing that. Well, filing the restricted application allows the spouse that's opting to delay their own retirement benefits, it allows that spouse at full retirement age to turn on half of their spouse's Social Security benefit. So in that scenario, the spouse A is going to receive $2,000 a month. Spouse B can restrict the application to receive half of that, $1,000 a month, until age 70 when spouse B switches over to their higher Social Security benefit, their own retirement benefit. So here, one way to look at that is the government is willing to pay one spouse to delay their own benefits. And remember, delaying your own benefits accrues delayed credits at 8%. Not too shabby. That's pretty good.
Jamie, when you're signing up for Medicare benefits, do you do that through SHIP?
No, you don't sign up for Medicare benefits through SHIP. They're just counselors that are there to help you understand what your options are. You sign up through Medicare through the Social Security Administration. They're all together. Social Security and Medicare are basically one and the same. One handles obviously with income, one handles health insurance, but you sign up for Medicare through Social Security. In order to get the supplemental policies, you can either go directly to the insurance companies or you can go to the exchanges. There are insurance agents that will help you get supplemental policies, so there are a handful of other resources. If somebody needs help identifying what their resources are, they can certainly ask. Again, I think the best place to start is SHIP, and they might actually be able to steer you into the right direction in terms of now that we've gone over your options, here's where you can go purchase that insurance.
What if someone doesn't need the required minimum distribution? Is there any way to reduce the tax liability that will generate?
Yep. So if you don't need it, you still have to take it. You don't have to spend it, but you can put it right back into a non-retirement account to invest. So you can't bypass the requirement to take it. Again, unless you fall under that exception where you're still working and you're less than a 5% owner. The only way that I'm aware of that you can actually eliminate the tax is if you donate your to charity your required minimum distribution, and we've done that for a fair number of clients. You can do it up to $100,000. It was grandfathered in now, so as long as Congress doesn't take it away, it was something that Congress was approving each year, but they've made it permanent. as much as you can use the word permanent here. And they call it a qualified charitable donation. And what you do is when you take your distribution from your retirement plan, it's important that you have the payment sent directly to the charity. You don't have to do $100,000. You can do up to $100,000, and you won't have to pay taxes on the amount that you donate to charity.
This is the last question that I have here. It says you mentioned nursing homes. This is one of our attendees' concerns. How does this person protect themselves?
Yeah, I mean, in retirement analysis, that's a really hard question to answer. It's the first layer of defense for some is to purchase a long-term care insurance policy that provides funds that are available to pay for a nursing home. Other than that, and long-term care is not appropriate for everybody. You know, I tend to think that there's a sweet spot for long-term care. You know, if you have $500,000 of assets, of portfolio, it probably doesn't make sense to go ahead and purchase a long-term care insurance policy, because that might cost $10,000 a year to obtain that coverage. That's a pretty steep cost to protect your portfolio. If you have $2 million, well, then the math actually looks a little bit more favorable for purchasing long-term care insurance. If you have $10 million, you can probably self-insure, and you probably don't need the long-term care insurance. You can still purchase it, and it obviously, compared to the size of your portfolio, is very affordable. But, you know, it might just be needless. So I tend to think that there's a sweet spot for long-term care, and that's why I say it's not always appropriate. I think there are ways to protect your home. There are ways to protect your assets. There's too many to go over right now. So again, I wrote a white paper on this subject. I think it's like 5 or 7 pages long, and it's got a lot of tips there that, depending upon what stage you are in life, are you single, are you married, it goes through that and gives you some available options to consider.
That's all the questions I have.
Okay, excellent. Thank you, Amanda. Thank you, everybody, for joining me. I'm going to sign off now. Just a reminder, we're going to have this video up for replay shortly, and there is a white paper that we'll be posting to our website. If it's not already there, it will be shortly. Amanda did give me a warning that our website is under construction. We have a group that's helping us redesign the website, so if things look a little off, please bear with us. But thank you all for attending. I appreciate your participation here.